Hello everyone, welcome back to another problem tutorial from our chapter 4 problem series of our financial management course BUS 223. In this particular video we're going to be looking at problem number 11, so let's read it together. It says, in the past year TVG had revenues of 3 million, cost of goods sold of 2.5 million, and depreciation expense of 200,000. The firm has a single issue of debt outstanding with book value of 1 million, on which it pays an interest rate of 8%. What is the firm's times interest earned ratio? Okay. Now, here the question wants us to find one specific ratio, which is times interest earned. So let's read the formula for this particular ratio. Times interest earned ratio equals earnings before interest and tax, EBIT, divided by interest payments. Okay, so that's the formula. All right. Now, that means in order to calculate this particular ratio, we need two components. We need EBIT and we need the interest payments. All right. Now, the EBIT, we can simply calculate from the data given. We have the revenues, we have cost of goods sold, and we have depreciation expense, right? So, knowing this, we can simply calculate our EBIT by the following formula. It's going to equal revenues minus minus cost of goods sold minus depreciation expense. Okay, which is going to be 3 million minus 2.5 million minus 200,000. Okay, 3 million minus 2,500,000 minus 200,000. And that's going to be $300,000. Okay. Now the second component that we need is the interest payment. Okay. And we do have some data regarding that. It says that the firm has a single issue of debt outstanding with book value of 1 million, on which it pays interest rate of 8%. Okay, so that means that the interest payment is going to be 8% of the face value of the debt issue. Okay, so we can derive our own formula. We can say interest rate, which is the cost of debt in this case, multiplied by the face value or the book value, book value of the debt. Okay, which is 8% multiplied by $1 million. Okay, and that's going to be $80,000. All right. Now that we have both components that we need, we can go back to our formula and find the times interest earned ratio. So that means times interest earned ratio is going to equal 300,000 divided by 80,000. $300,000 divided by 80,000. Which is 3.75. Okay. Now what does this mean? It means that the company can use their earnings before interest and tax to service the interest on their debt 3.75 times. Okay? The earnings before interest and tax of the company is enough to cover the interest payments 3.75 times over. All right. That's it. This is a pretty straightforward, pretty short exercise. I hope that you found it useful and found this video useful. And if you have any questions, please feel free to drop them down in the comments. Until I see you in the next problem tutorial, keep on learning, and I wish you the best of luck. Take care.